Okay, welcome everybody to week 2. And for those study 1 questions, that's one of the first things that we're going to take up today is that one take-home sheet that we had, which was a quick overview of some of the content that we went through in week 1. So I'll give you an opportunity to ask any questions and actually for you guys to respond with the answers to that sheet as we get going. I guess there's one more thing since I had the course opened. So we went through the calendar where you could always find a link to the Teams meeting. Module 1 is where you'll find the recordings. But we also have this discussion board. Recall this was one of the takeaways from week 1, where we had the insurance companies in the press. So there's only 4 responses, and they're all me. So the intent was, could comment and post a reply on any of these threads, whether it's the Aon report, the CEO profile, or most impactfully and significant to get used to the P&C leaders is in this Canadian Underwriter Outlook, which a lot of the broker CEOs and senior people in the insurance companies have posted their outlook for 2020. So have a read through whichever ones the companies you find most interesting. Put a thread in there, which one you reviewed, any questions that I could respond to, or any comments or observations that you have based on their outlooks, because there's a lot of similar themes. Okay, so that's in the discussion board discussions, okay? So let's jump over to our slide deck for today, and then we'll get into the class. And any questions, comments before we get started? And again, feel free to take yourself off mute. If it gets too chaotic, then we'll control things with a hand up and the rest, or feel free to put anything into the chat and I'll try to monitor it throughout the class.
How do we need to submit the homework you gave in the last class?
Yeah, so that one we'll just take up in class, so you don't have to submit that. The only thing to submit,
I submitted that in the Word file.
only thing would have been, I'm just checking out how it showed up, was the week 1 introduction. Okay, so week 1 introduction just had those 3 questions to provide that background, your background, so I could just see what the baseline is for everyone's either education or experience with accounting, with math, that kind of thing.
I was asking about the learning assessment one.
Yeah, the learning assessment one you do not have to submit. We're going to review the answers in class.
Okay.
Today.
I submitted that in the Word file.
Correct. Yeah.
Okay. Thank you.
Okay, assessment 1 due date is 20th. So I don't think it's the 20th, that's today. Oh, I think, yeah, I had put in that I wanted you to do that week 1 intro. So it was due today, so I have it. And then the second one might have had a due date for the 20th, but that's because we're going to take it up in class right now. So I think that was the same question that we just talked about. All right, so just a couple of slides to get us started here. So we do jump right into things. This is what we're going to be reviewing this week. We quickly went through some of the financial statements last week, and we're going to use that assignment to review it again. We're going to talk more deeply about the accounting equations and some accounting principles. I'm going to talk about the most significant ones, and there's more details in the course workbook. So as we go through the lecture today, I'll reference you to sections of the course workbook, which again is that first item in the module 1. And then we do get into this concept of T accounts. So I mentioned last week, and the whole basis for this class is not to train you to be accountants, but to understand the impact of insurance activity on the financials. We have to build with some basic building blocks of how finance works and how the accounting works. And we start with a very basic building block idea of these T accounts. And then we could move on to the next step in understanding the insurance specific metrics and information that's presented. Okay, so here's some of the goals for today. Again, we'll go through the common financial statements. We look at some insurance specific ones and how they're organized on the statement. We use some T accounts, and we do want to get your feedback to help your understanding as we go through it. So even if it's very basic responses, getting you used to responding back helps create the discussion and using insurance terms and accounting terms in the vocabulary as we start to understand the insurance language. Okay, so I'm actually going to use some breakout groups. So when you get into your breakout groups, we'll need somebody. You'll have to take yourself off mute, work through the problems. Then when we come back, I'll need a spokesperson for each group. Probably not every group will get called on, but we need a spokesperson to come back with the responses. And again, that's going to help you understand and retain the information that we're covering in the class. All right, and here's the order of things. I am going to start with, a real live press release. If there is anything that you do see from week to week, send me a link to it or bring it up, and then we could use that as the discussion. And then how does the course content relate to the information that we do see being discussed in the media? So some of the assessments, again, to help reinforce what we're learning in the class, is we're going to review as a class discussion the responses to last week's assignment. You're going to have a couple of small group activities where you could work through some of the content that we're doing today, and then there'll be a take-home one as well to give you some more practice. So as I mentioned last week, we front end the midterm and the final compared to the other classes. So we do quickly have to jump into 4 weeks of content leading up to the midterm in week 5. So it is early. To help prepare you for that, it's the questions that we're doing today. There'll be similar types of questions that you'll find on this test 1 and on the midterm. And what I do here for test 1 is at the end of class next week, I open up the test, but you'll have a full 8 days to complete it. So we'll have the test will be open where you could start it within the time period. But then if you want to retake it, because you've gone back to your notes, gone back to more practice questions, attended this class, then you could retake the test again, as long as it's done and finally submitted by the final due date, which is after our 4th class, okay? I'm also confirming some office hours we're on Tuesday. I think I mentioned this last time, on Tuesday at 4:30 for 4 times throughout the class, throughout the course. I'm just confirming those dates with Professor John, so I'll put them in the announcement and then add them to the course calendar as well. And then you'll see which weeks I'm actually open for those class office hours. They'll be ahead of the test 1, ahead of the midterm, ahead of test 2, and ahead of the final. So you have that extra opportunity to ask the questions. And again, within the critical path, you'll see how the marks for the class are split up. Okay, so I said we'll start with a quick view of item in the press. So let me switch over to that. Oh. Okay. So this was, and I have a link to this direct press release in the discussion board. So this was intact, again, the one I use an example frequently, their press release for their Q3 results. And these are the key metrics that they focus on, and you'll see some themes when you compare it to other P&C companies. Now, we don't go into the details in this class of all of these items, but we do talk about their premiums growing, and then they describe, where the growth is coming from, and then they highlight this combined ratio of 91%, 91.3%. And what they're commenting on here, we'll discuss, is this number good or bad? And they're saying that it's at this level, despite an elevated 7.5 points of catastrophe losses. So the fact that they're highlighting catastrophe losses as their one single outlier when they talk about combined ratio. So we'll spend some time throughout the whole course talking about why we focus on losses, and specifically catastrophe losses. And then there's some other metrics that we don't have time to get into the class, like return on operating equity and earnings per share. These are kind of common for any public company. The insurance-specific ones are the premiums and the combined ratio. And then some of the commentary that by the end of the class, we'll understand why they focus on it. And again, he's talking about is their operating performance, despite elevated level of CAT. So again, they're using time to talk about catastrophes. Our people have worked hard getting customers back on track following many severe weather events. So again, they're talking about a certain type of claim that's having a significant impact on the business. They have this chart of metrics. Again, they focus in on premiums and combined ratio. And then they have this idea of their underwriting income, which is part of their net income. It's a subset. So we'll talk about underwriting income. And I just want to have one further point here on the industry outlook. This part here, Canadian industry profited, improved. The whole industry improved for the 12 months to June, helped in part by benign weather. So the things they're talking about is weather, favorable PYD. So prior year development is this acronym. So we get into what does PYD mean, and reduced driving is just another impact of what's going on in the market on claims. So they spend all of their commentary talking about these claim events. And then some impact of favorable market conditions. We talk about firm market and hard market conditions. So both of these items you'll touch on in other classes, and then we spent some time talking about a firm market, hard market, same thing, versus a soft market, okay? So these are the types of commentary, metrics, the language that insurance companies use when they talk about their results and their plans and so on. So that's why what we're trying to unpack in this class, so that we understand what these terms mean and how they impact the results. So it's taking a step back. We're going to take a step back and start with the small building blocks of accounting and finance, and then we work up to understanding how weather and PYD are tracked. Was I not sharing the this intact website? Hopefully you could see that. I've now, okay, good. Now stop sharing. I'm going to go back to the, okay, good. Good. So we're going to start by, I'll go back to this, our slide deck. And when we get into the financial statements, what I do want to use before I go through it is to review what the takeaway, the homework was from last week. Okay, because you can see the slide I have up right now is the same deck that we went through last week, and the questions sort of had some fill in the blanks to identify the different statements. So let's get some of your feedback on the questions using that as a guide, and then that'll help me determine how quickly we could do the review of some of these things again. So I'm just going to pull up the questions. Of course, you have them as well. So whether you want to take yourself off mute or add it into the chat, we'll go through the 4 pages here. The more quickly get your feedback, the more quickly we can move on. So we have, again, I'll just zoom out so we could see the whole page. We have these 5 questions: what statement, fill in the labels, what accounting equation would you use, there's some missing numbers, and then describe the time period. So, and then we have this financial statement here. Okay, so let me zoom in. All right, so we'll try to get started here without the chaos of everyone shouting out at the same time, but let's see how it goes. So which financial statement do we have here? All right, so we got this is the balance sheet, correct? Missing labels. This one might be a bit tough, but the first box is going to be the name of the balance sheet, which is what you've responded to already. Let's go with the first heading here. Yeah, a couple people coming in on, this is the assets. The next one, so this heading was assets, and then this is a subtotal here, total assets, that's right. Then getting into the next box was the liabilities. Glenn has come in on the liabilities, that's right. Okay, good. Looks like we're good on the labels for this one. Without doing any math now, the question was fill in. Oh, okay, let's do this one first. What accounting equation do we have for the balance sheet? And if someone has limited experience with finance or accounting, then this would be, you guys almost got it right. There we go. The first couple, we're just saying assets and liabilities. No, it's assets equal liability plus equity. So the bottom half of the statement is our liabilities and equities together match the total assets. Very good. So knowing that, without doing any math, the question says fill in the missing numbers, which is their subtotals. So what would in this column here for 2020, this missing number, which is total liabilities plus equity, what would this number here be? Now, of course, you could add them. Yeah, 35,119. So you know that we're showing the total assets already. And we know that the bottom half of the statement has to match the top half. So without even doing any math of adding up the liabilities plus equity, you know that the total is the same as the assets, okay? That's the balance sheet, always in balance. Describe the time period for this statement. I'm not sure if someone wants to take themselves off mute to answer this one, or put it in the chat. Describe the time periods for this statement.
It is as on a specific day.
That's right.
December 31.
Yeah. So the key was there, it's as at the specific date, that date being December 31st. And that's noted right here at the top of the statement. Okay, let's jump to, very good. You guys got it. The next statement, I just zoom out again. Some of the items that you see is premiums and revenues. It lists claims and net claims incurred as a net income before taxes. Same types of questions. What financial statement are we talking about here? The income statement. Yeah. That would be this first label. You could call it the consolidated statement of income. All right, what other labels? So what are the two groupings here? First subtotal. Total revenues, yep. And this is the grand total of what this income statement totals to. Yeah, there is actually no total expenses on this statement. If it was total expense subtotal, it would be a total of these rows. Some statements do show it. This statement does not. But this is the net income attributable to shareholders. Okay. So the cash flow one, that's on the next statement we get to. Net income attributable to shareholders is this 1,082,000. What else are we saying here? Okay, accounting equation that we use for the income statement. So the accounting equation for this one is it's our total revenues minus expenses equals the net income. Okay. Yeah, there you go. Revenues minus expenses. Now this one we'll spend some time on today, but we might as well, I'll get your feedback. It was something I asked you to look up. Which accounts are used for the combined ratio calculation? You can't really circle them. Maybe someone would take themselves off mute just to add in which accounts we're looking at for the combined ratio. All right, so this was a concept, yeah, that we talked about and we'll get into again. So yeah, the combined ratio is the loss ratio and plus expense ratio, or claims ratio plus expense ratio. That's correct. So the accounts that we use are, we need the earned premiums. That's the basis for those ratios that you just referenced. And then we look at net claims incurred and the underwriting expenses. This is where we get the loss ratio and the expense ratio from. So we get into that, but these are the underwriting activity specific accounts that we're focusing in on, earned premium, and then these first two expenses are the two that we use for when we talk about the underwriting result and the underwriting ratios, like the combined ratio. The rest of the accounts on this statement are non-insurance specific. So when we talk about the insurance performance, we're looking at just a subset of these accounts. Last question that we'll go through here is describe the time periods. In the balance sheet, we said it was as at a certain date, December 31st. What about this, the time periods for the income statement? Yeah, so it's the activity over a period of time. It's, in this case, it's over a year, ended on December 31st, 2020 for this column, and the year ended December 31st, 2019 for the second column. Okay, balance sheet was as at a point in time. This income statement is over a period of time, 1 year. They could have income statement for the 3 months ended, for the 1 month. Okay, but the idea is it's over a period of time. All right, I'm not, we won't, that's very good, thank you. We won't go through these last two, but if you wanted to see the responses in the workbook, so I just switched over to the workbook. The slides have the details as well, but you could pull out the PDF in the workbook, and then it walks you through all 4 of these financial statements with the notes and the highlights, talking about the time period, talking about the labeling, okay? So that was the statement, changes in shareholders' equity. Page 12 is the cash flows. So those are the 2 that we didn't just cover, okay? And again, I focus in on the name, the time period, and then the groupings of each of the statements, how the information is grouped. We don't need to go into the contents of how it's calculated in these ones. Okay. All right, very good. So that was a review of this of the summary that we did. I'm going to actually be able to go through a bit quicker on the slides, and then we'll spend some time just focusing in on the combined ratio. Okay. All right, so now I'm going to switch back to our PowerPoint for the week. All right, and then the ones that we didn't, we talked about those questions had the details on these 4 statements. Where we get the other financial information are in the notes, which is more the IFRS prescribed disclosures. MD&A allows the company to present the information in the way that they use the classification, so it may be different than the IFRS view, but it's in the way that the management groups the businesses. Okay, so we get more meaningful information from the companies, typically from the MD&A versus the details that are in the notes. And then you'll see the auditor's report as well for any publicly available statements where that have been audited. All right, and again, the details of the numbers aren't important. We're going to talk about the classifications. The key numbers are that the total assets equals your total liabilities and equities, which is the accounting equation, which a lot of you guys responded to already. So that's good. The main classifications, assets that the company owns, this is what the company owes, the liabilities, what it owes to third parties, and here's what it would owe to its shareholders. And the fact that it's a snapshot at a point in time. Those are the keys. We're going to focus in later classes on the insurance specific assets and liabilities. So we have premiums, receivables, and reinsurance assets. We get to reinsurance afterwards. The main liability here is the claims. So this large amount here for claims liabilities, this is what the insurance company is designed to do, right? It receives premiums, holds the cash that it receives as investments so that it could pay out to the claimants and policyholders the amount of claims in the future. Okay, that's how the insurance company's balance sheet works. Later on, we'll get into this idea of unearned premium. Okay, so income statement. We talked about that accounting equation is net income is revenue minus expenses. So when I ask you those questions, I mean, the responses are going to be here. Of course, when you get used to answering them, when you do come across the question in a test, if you know it, it's quicker to respond. If you know where you've seen it because you've studied and reviewed the content, then it's easy to refer to it and then complete the tests and assignments when we get to that stage. The other key point is the time periods over a period of time. Some of the keys that we'll focus in on, this is the full income statement attributed to shareholders. Next is, let's just look at what the underwriting activity is. So we'll come back to this looking at just the insurance specific accounts. Statement of changes in shareholders' equity. Again, you could find it in the workbook for more of the details, but what we're doing is taking the equity as at the opening, January 1st. Here's what the equity is from the balance sheet as at a point in time, December 31st, and what's changed in that equity. The main one being the net income. So it's what's happened between these 2 points in time that changes the equity, which is that one part of the balance sheet. All right, so let's get into, oops, sorry. Just the components of the income statement related to the insurance activity, okay? So we talked last week that the top line, the direct premiums written, are the sales, but the revenue for the insurance company is its net premiums earned. So we'll go through the difference between direct and net and written and earned. What's important now is that the revenue is the net premiums earned. Okay. We spend almost a whole class talking about the difference between these two items. When we look at just the expenses, we're going to talk about the net claims incurred and the underwriting expenses, which are the two largest expenses for the insurance company. They're listed first when you get to the expenses on that income statement, and then all the non-insurance expenses follow. We do have this small amount, and I'll raise it here. We don't spend a lot of time on it because it's always a small amount for insurance companies, but it's the way that they disclose it. So if you ever were looking at, say, Intact's financials, and you're trying to recalculate how they came up with their ratios, what we do is they have this small amount of other underwriting revenues, and that could be policy administration fees, some kind of financing fees. If people are paying premiums on deposit, they have to pay an amount almost like an interest or an admin fee. The insurance companies don't like counting that as their revenue. We just like counting our earned premium as revenue. So what we do, even though on the financial statements, we have to show this as a revenue amount, but when we do our ratios and other performance metrics, we actually take this small revenue amount and we deduct it from the expenses, okay? So other revenue is not included as revenue, but included as a reduction of expenses. So what we do here when we take our underwriting expense ratio, we take our underwriting expenses less our other revenue to come up with a net number. And then we take that resulting number divided by net premiums earned. Okay. So I don't test that. You won't see that in a test in the course, but it's important to note. And these, this is a quote from how the insurance companies actually disclose this, that the expenses and general expenses are presented net of other underwriting revenues. Okay, so that's it, what I just described. Hopefully this presentation of net claims incurred slash net premiums earned, that means it's a ratio. So we're taking it's a division. So we're taking net claims incurred as a numerator divided by net premiums earned. Okay, so I've gone through some classes and some people, students ask me classes later, says they don't understand what this slash meant. So this is divided by, and a ratio is always referring to a division. So you're going to come up with a percentage. So if you ever unclear on some of the terminology or the way I'm presenting something, please ask. It may not be, it's obvious to me, but it may not be obvious to you. It's obvious to me because I wrote it. Hopefully it's common terminology. If it ever isn't, like again, please ask. What's shown here, the other point on this slide, in underwriting expenses, there's three main types of expenses in this underwriting expense. There's commissions. So this is the commission the insurance company pays to the broker. There's operating expenses. So this is what the insurance company pays for all of its expenses. Its staff, its rent, professional fees, IT expenses, marketing. And then there's also premium taxes. So in Canada, it's kind of unique to Canada that there's a tax whenever an insurance company has a sale, the insurance company has to pay a tax to the province that it's made the sale. It's usually between, say, 2.5% to 4%. It's not the same sales tax that the broker is charging the policyholder. That's a different retail sales tax on the premium. Okay, that's a cost to the person buying the insurance. This premium tax is a tax to the Canadian company who's made the sale of a direct premium. Okay, all three of these together are included in this underwriting expense. So when we talk about the combined ratio being the sum of the claim ratio and the underwriting expense ratio, this is a different way to look at your performance than most companies do in other industries. Okay, most companies, say it was a service company or manufacturing company, is going to talk about their profit margin. So that might be a term that you've heard before, right? The company had a profit margin of 10%, which means for whatever dollar they bring in, they're making 10 cents of revenue, okay? Or 10 cents of income, sorry. So let's just look at how a margin compares to the combined ratio, because there's a relationship. So in this case, when we have our underwriting results, our revenues, that's our insurance expenses. We had revenues 11,376 minus our expenses. We have underwriting income 797. What a manufacturing company or service company would do is say, well, I have this income 797 divided by my revenue. Again, we're just going to use our premiums earned as our revenue for the ratios, 11,241. So they're going to say I had a margin of 7.1. Okay, that is 7.1% profit margin. What insurance companies do, it's almost the inverse of that. We're going to look at our claims ratio, 6,883 divided by 11,241. This is our claim ratio, 61.2%. And then our underwriting expense ratio is our underwriting expenses net of these other revenues. So we get 3561. So we take 3561 divided by our net premiums earned. We get 31.7. Add those two together, we get our 92.9. It's our combined ratio. So what you'll see, the relationship between the combined ratio and what a profit margin would be, it's if you take 1 minus the profit margin, 1 minus the 7.1, you get how we present the insurance company's performance as a 92.9. Okay. Excuse me. Okay, so if you're comfortable from coming from another industry, what a profit margin is, 1 minus the margin gives you what the combined ratio is. So if the margin is higher, then that's a good thing. So the inverse for the combined ratio, the lower the combined ratio, the better the result, right? There's less expenses. So that means there's more profit. If the combined ratio ever got to 100, then that's equivalent to a profit margin of 0, which means that's the break-even point. So a combined ratio of 100 means there's 0 underwriting profit. If it's over 100, then that means it's an underwriting loss. The company's losing money from its underwriting operation. Let's just look at it a bit more closely here. Okay, so this is just looking at the 1 year, again, where we have loss ratio or claims ratio. The underwriting expenses, again, the underwriting expenses are commissions, operating expense, premium taxes, and net of the other underwriting revenue. All these ratios are divided by your net premiums earned. So hopefully that's clear for everybody. And then you could also calculate the combined ratio by looking at 1 minus the margin, and the margin being income divided by the revenue. I'm going to pause there. Did anybody have any questions, comments? Did I go too fast, too slow? The concept, and I have some presentations from other people in the industry that will share that review these same concepts, and you'll recurringly hear this theme of a lower combined ratio is good. If it goes over 100, then that's our break-even point. Okay. What some classes have, and I'll review that where I have the worksheet, is to actually go show the math of how those ratios work. So when I say it's the claims amount divided by the net earned premium, I talked about what those dollars were. Hopefully you're comfortable seeing that that's the numerator and denominator, the one number divided by the earned premium to come up with that ratio. Okay. I understand everyone's at different baseline for ratios and accounting and math, but hopefully something like that is understandable, at least as we get into more examples. Let's just pause there. We'll take a 5-minute break. If you have any questions about that term ratio or anything that I've covered so far, think about it, put a message in the chat, or come back and ask a question. We're going to go into some more details of the building block concepts when we get back after the break. Okay. So 5 minutes. That'd be 11:45 Eastern time. All right, hope everybody is back. Before I jump to the class, since we just talked about combined ratio, let's just pop back into that press release that I started with from Intact. All right, so back to this. So here they talked about their combined ratio, 91.3. So that's less than 100. So that means they made, they are profitable. They had underwriting profit. 91.3 is very strong. Typically, the industry average is probably a few points higher, maybe 93. And then they're coming here despite elevated 7.5 points of cat losses. So elevated 7.5. What they're probably saying is that within this 91 included 7.5 percentage points related to cat losses. So if they didn't have any cat losses, it would have been 91.3 minus 7.5. Their combined ratio would have been even lower. Okay, so that tells you that the insurance company, insurance operations received X amount of premium. They're able to pay the losses. They're able to pay expenses. Part of their losses included this large amount of catastrophe claims, and they still had profit of 100 minus this 91.3, so 8.7% profit margin on their underwriting activities. Okay, they still make income from insurance, from investments and other activities, but just their underwriting operation had a strong profit margin, 8.3. Okay. So let's jump back into class. Oops. What happened here? There we go. Okay, so in the workbook, I have some more details on the building blocks that we'll be reviewing. What we're trying to relay in this course is the accounting concepts. And then the idea is once we have these concepts, we could apply them to any type of insurance activity that may come up in your experience. Okay, so I picked some key ones and we use those as examples. But the idea is if you're in a different scenario, you could apply the same concepts, and they're true throughout accounting for any type of organization. Okay. So the basic one that we're going to be building on, and it's good to get that understanding because you've seen the insurance company's balance sheet is unique in that it has a lot of investments and it has this huge liability to pay claims. So we always have to see that balance, and this accounting equation always has to stay true. And I've described it as what the company owns its assets. So this is like its cash, its investments. These are things that the company owns. It could have some intangible items, which we don't, get into the discussion through this course, but things like goodwill and maybe intellectual property. And versus what the company owes, all right? And the balance sheet is at one snapshot at a point in time. So I do want to spend some time on this relationship between the balance sheet and the income statement, because if everything is all in balance, how do we get the income statement activity through the balance sheet? Okay, so I like this view to show when we have this balance sheet equation always staying in balance, here is just breaking this equation out into the components of owner's equity to illustrate how income and revenue and expenses impacts the balance sheet, okay? And this is why it is the case. So within the equity part of the balance sheet, it's made up of two main things. There's the contributed capital, which is the original stock or share contributions, and then this idea of retained earnings. Retained earnings is all the accumulated income from the beginning of time of this company. And the way that it's shown on the balance sheet is there's an opening, beginning of the period, and then it's the net income less dividends. So we don't talk too much about dividends, but this net income, we do, because this net income is what we see coming in from the income statement. Again, so we're taking amount of accumulated earnings at the beginning of a period, and then we say over a period of time this is the start of a period, January 1st, and then any revenue and expenses from January 1st to the ending point, December 31st in this example. Then we could take this net income, revenue minus expenses is net income. This net income increases, or if it's income, it increases retained earnings. If it's a loss, it'll decrease retained earnings. And that's how it's presented in the balance sheet at the point in time, okay? So the net revenue and expenses over a period of time gets included in the balance sheet as at a point in time. So let's just go through some scenarios here for an insurance company example. If they had, we made a sale of premium. Okay, so we had revenue. So we increase revenue and we create something that we own. We're going to record a receivable from a policyholder. Okay, so that's something the company owns. A setup, you owe me $100. I sold you a policy for 100. Assets go up, revenue goes up. The increase in revenue increased net income, which increased retained earnings, which increased owner's equity. So if owner's equity goes up 100 and the assets went up 100, then this equation is still in balance. Okay. Let's look at another example for a claim came in. So there's a claims payable. We're gonna we know a claim happened, so we're gonna record. We haven't paid it yet, so we'll record here's something that we owe somebody. We owe them this claims that we're going to set up as a claim liability, and that's an expense to the insurance company. Okay, so we have liabilities going up and expenses going up, but this increase in expenses decreases income because it's revenue minus expense. So expense going up decreases income, which decreases retained earnings, which decreases equity. So we had liabilities went up, owner's equity went down, no change in the assets. Okay, so we have that balance. And that's how the activity between the balance sheet accounts and income statement accounts still keep this accounting equation in balance. Okay. So that's a little deeper look at the balance sheet accounting equation. Some of these accounting principles are generic, like I said, for all companies. I'm just going to focus in on three of them here that are specific to the insurance company discussion that we'll come back to. To see the details of all of them, Actually, I'll zip over to the workbook. And then you'll see a paragraph on each of them. So let's go back to the workbook. So I'm here on page 14 of the workbook. I have this chart again, which you could refer to. And here's a list of the accounting principles and a paragraph on each of them. We're going to spend some time going through examples of what this dual aspect means. But if you think that this accounting equation has to stay in balance, that means if there's an increase in assets, then you either need to decrease another asset, or you have to increase liabilities, or you have to increase equity. So two things have to happen to keep that accounting equation in balance. So that's our accounting principle, the dual aspect. Okay, if something increases, something else has to change in an equal amount. And we use this term debit or credit. The illustrative example using T accounts is the idea of we use a left side and a right side to keep like a scale to keep things in balance. The other one that we'll talk about is this realization. So we could only record financial transactions if something has actually happened, and that thing is, we don't think it's going to happen, but we have to wait for the day that it does happen. So I have this example, if we have, we agree to terms on a policy renewal, because the insured wants to know with certainty that they have a policy on a certain date. So you agree to those terms beforehand, but we don't realize that sale until the day that that policy that is effective. Okay, so we might do some work on a June renewal in April, but we don't start recording that sale until June happens. Okay, when we could start to realize that revenue, realize that sale. And then another one is our matching. So our matching tells us that we have to match our expenses to the related revenue. The insurance company's problem is we don't know what the expenses are, their main expense being the claim. So at the time we make the sale, we don't know what our expenses are with certainty, so we use estimates to create an expense, so we have that matching principle. Over time, we'll know what the claims are, but we have this matching principle concept that we have to record a claim expense now to match the sale and the revenue. Okay, so we use this matching principle, and that drives, for the most part, our claims expense that we have to report, because we have to match it to the revenue from the policy as best as we can. Cool. All right, so that was the cue to move along. Okay, so now I'm going to go back to the course presentation here. Again, if you wanted to read more on these other accounting principles, they're there in the workbook. Okay. So looking at our dual aspect, and this is where we're going to get into some examples, and then I'll let you guys get more engaged by working through some examples. Just a few more minutes here of the lecture part. But this is the dual aspect. Some of the abbreviations: asset, the liabilities plus owner's equity. Okay, abbreviating it down to some initials. The idea for a dual aspect is debits equal the credits. Okay, so just how when we put things into buckets of assets, liabilities, owner's equity, and owner's equity we know includes our net income, so our revenue and expenses. All right, so some ways that we get the debit side, and there's another chart I'll show in the workbook that goes through the ups and the downs and pluses and minuses, left and rights when we talk about T accounts. But just to go over right now, to increase an asset, that's what this is representing, is a debit. The opposite happens to liabilities. We decrease a liability with the debit. And we could increase our expenses with the debit entry as well. Okay, on the credit side, the opposite, or the opposite directions for assets and liabilities. And we also, a credit would be an increase in revenue. Okay. We could have a decrease in revenue, is not shown here. We don't typically have a decrease in revenue, but that would be a debit, and a decrease in negative expense would be a credit. Okay. Yeah, I think when we go through the T accounts, I'll go through that view in the workbook in just a second. So what we're finally getting to here is, again, accounting is just organizing these financial transactions into buckets. Some of the terminology that you might come across is, we gather the records, we journalize them. That's just how they're organized into individual transactions. So break them down into each piece at a time. We're going to post them into a ledger. In this case, our ledger is just going to be some T accounts. It's a good visual to keep what is going up versus what's going down in balance for that dual entry. And then all of that activity gets summarized in these two main statements that we'll come back to, that we spent a lot of time talking about, at least how they're organized, the balance sheet and income statement. So I'm going to put you into some breakout groups within teams here. As I mentioned at the start of class, there was an item there under week 2 for some questions. So let me go back to that. Again, just so you could access it. Okay, so in our course content, give me 1 second. So in the course content, under week 2, module 1, week 2, this one should be first. Sorry, week 2, questions for in-class breakout group. Download. Surprised you can't click it to open it. That's too bad. So you have to download it and then open it. Come on. I want to make sure you guys can all see the same thing here. Okay. So week 2, assessment number 1. I have just 1 page of some questions here. This will review some of the things that we talked about so far in class today. Okay, so I'll put you in groups of maybe 5 people. Go through their responses. I'll bring you back in 10 minutes. Have somebody from your group ready to respond, and then we'll go through these. Again, it's just another way to reinforce some of the content that we've done. After we do that, we're going to jump into some T accounts. But let's make sure we have a good base for these questions here. Okay, so is everybody good on, we're talking about this document week 2 assessment 1. I just showed you how to download it. Work within your groups to go through the responses, and then we'll come back at 12:15 Eastern time. Okay, so give it a second if for Teams to put you into groups. Okay, here we go. Okay, there we go. Good, good, good.
Oh,
Okay, welcome back.
Welcome back.
We'll wait for
We'll wait
everyone
for
to
everyone.
begin.
Again,
Just
just
we're getting some
get
feedback
some
on some
feedback.
still to mute their mics. Okay, I think everyone's back. Hopefully that worked out. Um, I think it's a good way to help reinforce it. Plus, it gets you part of the class, working with your classmates too. I'm not sure what the other professors are doing to create that online class environment, but let's go through some of your responses here. So why don't we start with which financial statement you find the operating income? Someone from group one could handle the group one, handle these first two. You take yourself off mute, someone from group one, or you might not know what group number you were in.
I don't remember what group number. Yeah.
I think it's income statement.
Yep, income statement is where you find operating income, and is the operating income or the underwriting results the same as the net income attributed to shareholders?
I'm really not sure about this answer, but according to me, it's not the same.
Right. That's true. So the more detailed response will ask, what's different. I'm gonna pull up my answer key for the complete answers here. So the underwriting result is the operating income for the insurance company. Okay. Net income attributed to shareholders also includes all the non-insurance type activity. It's revenue and expenses. Okay, so underwriting result is a subset of all of the net income. All right, so next question, someone group two could talk about this dual aspect. Can you have a one-sided entry? What if it's immaterial?
So no, we can't have a one-sided entry. And what if it is for an immaterial amount? These are included as miscellaneous expenses.
Mm-hmm. Yep,
So
that's right, because you need that dual entry. And the trick there is if it's immaterial, then it's that's another accounting concept. If it's not material to capture that detail, then neither the debit nor the credit are captured. You can't have a 1 cent debit and nothing on the credit side. Everything has to have a dual entry. That's correct. Okay. All right, so that's here's a complete response to. I'll show you where these are afterwards. Let's jump into. I saw there was a lot of chat.
Question, Professor.
Yep, sure.
So let's say if there are there's just not one immaterial expense, but there are, let's say, 20 immaterial expenses together, right?
Mhm.
Which amount to a bigger expense for the company as a whole.
Mhm.
So in that case, do we put these immaterial amount, like individual amounts, together as a miscellaneous expense or not?
Yeah, so that's yeah, this whole everything, if it's a financial transaction, then it would have to be included. So where immateriality sort of comes in would be, say there's a office expense for pens. So the company buys a box of pens and they assign it to 100 different people. We're not going to record the cost of one pen to person A, then the cost of one pen to person B. That's level of detail is not required, but the company would have to record the cost of the whole box of pens. So we're not capturing detail that's not meaningful. Okay, but you still have to capture it as a cost in total. Yes.
Thank you.
Realization. In September, you bind a November renewal. I saw there was a lot of chat around to the right response here. So maybe someone from group 3.
Yeah, it would be in November itself.
That's right, because that's when that policy actually starts. Okay. Maybe same group. What type of costs are reported to match when the premium is earned? Okay. So realization tells us when we start recording the premium. Matching tells us we have to record some expenses, but which expenses are we talking about?
Claims expenses, underwriting expenses, and other expenses in relation to possibly policy administration and stuff.
Yep. Yep, very good. That was very complete answer, because really it's all of the costs, and then you just went through all the costs related to the insurance company. Very good. So group 4, the last one, how does a balance sheet stay in balance when we create an asset which is offset by some revenue, written premium in this case? This is
unfortunately, Professor, we didn't reach that.
Yeah, and it is the most complicated one. So it is one that I keep coming back to, and so I'll take that one. And just for your reference, this answer key, I'm actually on page 41 of the workbook. It has the solutions, so good to work through it. And then here you have, my complete answer. So let me I could read this out here. The assets are increased and matched with an increase in shareholders' equity. So that's our balance sheet equation. The revenue increased the income, and then the income increased the retained earnings, which increases the shareholders' equity. So that's how we keep this equation in balance. And just to get the visual of how that works, I'm just going back up to the pages. That was an example of this view here, where we have the balance sheet equation. We increase the assets, and we increase revenue, which increased net income, increased retained earnings, increased owner's equity. So that example of increasing the receivable, an asset, and increasing the premium had an impact of increasing the owner's equity. Okay. All right. Yeah, we have a question. Go ahead.
What is the other term used for receivable assets?
Another term for receivable?
Yeah, receivable assets.
Okay. Create a receivable asset. Okay. So what I was just describing here is one that it's a premium receivable, and it's part of the asset category. So that's a good question, because let me just go to the balance sheet. Okay. So as we're giving you the views of these balance sheets, we weren't drilling into too many of the details, but one of the premium or insurance related assets are its premium receivables. So that was an example of this premium receivable in the asset category of what would increase when the company makes a sale, a written premium, and it's going to create a receivable, doesn't receive the cash yet for the premiums. So this is the receivable asset here on the balance sheet, premiums receivable. Okay. Okay, very good. So that was that first assignment. I'm going to jump into some examples now of how we're going to record other financial transactions. I'm going to give you an overview of how T accounts work. I'll refer back and forth from the slide deck to the workbook because there's comp parts in both. I'm going to pull up an Excel file and go through a couple of examples. Then I'm going to give you some examples to work on as a group. And then there's some takeaway ones if you want additional practice that you could work on through the week afterwards as well. Okay, this is the last bit for today's class. And we're getting into recording some of these transactions. Dual entry is the key to make sure everything's always in balance. And I'm just going to give you some of the concepts and principles of how we use the T accounts. Okay. All right. So let me, since I'm in the workbook now, all right. So what I'm going to go through starts on page 18 in the workbook. And this is how we track the financial transactions. If you are an accountant and you have an experience with journal entries and you're more comfortable doing a full journal entry, you could do that. If you like, you get to the same answer. Using the T accounts is more visual. And again, it's that same consistent building block that we're going to use to the course. You'll see in some of the answer keys that I give out for the answers, I'll have here's the T accounts and here's the journal entries. Those journal entries I'm not going to go through, but again, if you're more comfortable viewing transactions that way because of your other experience, then that's fine. But we're going to stick to the T accounts. Page 18 is where it starts. And let me see what we're going to go into. All right. So the way that we call it, the T account, is that we have an account, any account, it's going to have its name. This is a generic for any asset. So any asset name. We have a line just to identify the title from the transactions. And we have a line down the middle to separate debits and credits, left side, right side. And this view of the heading and a line down the middle, that's the T. All right, so very simply, it looks like the letter T. And we have left side, right side. The plus and minus, and this is your cheat sheet, your guide. That plus means this is an increase to this account, and this is a decrease to this account. So if we wanted to increase an asset, any asset, and you could go to the balance sheet view to see what our assets are, their cash, investments, receivables, something that the company owns is their asset, are their assets. If we wanted to increase an asset, you use a debit. So conversely, to decrease an asset, it's to be a decrease, a minus sign, is a credit. So this is a guide for the liability account, any liability account. So the main liabilities we had were the claims liabilities. There was some unearned premium concept we'll get into. There's other payables, so something the company owes to somebody else. To increase a liability, it's a credit. Right-hand side of the T. Okay. Now we show owner's equity, but from that other chart, we know that within owner's equity is any activity that happened in the income statement, which is our revenue and expenses mostly. So let's just look at an increase in revenue. Plus side is a credit to increase a revenue. That's the right-hand side. Increase in expenses, left-hand side. So if we go through a couple of those examples I used when we looked at keeping the accounting equation in balance. So the first one was if we had some written premium and we created that receivable, that asset premium receivable, right? So we increased the asset debit and we increased the sale, the revenue. So increase of revenue is the credit. All right, so we had $100 in amount, left-hand side, the revenue, right-hand side. So that's the dual entry. Left-hand side, right-hand side are equal. Our debits and our credits are equal. So that's the dual entry for an increase in revenue, creating an asset. If we had the claims payable example, where we're increasing our claim liability, something we're going to owe to a claimant, and create an expense. So that's a scenario where we're increasing the liability. Right-hand side, plus side, it's a credit to the liability, and we're increasing expenses. Plus sign means we're increasing the expenses, a debit, left-hand side. So again, our credits equal our debits. You get that balanced entry, okay? Now, of course, those were both examples where things were increased, but you could have a transaction where, say, we received cash for a receivable that we had. We had a receivable from a broker for premiums, and then they paid us. So we're going to increase cash, debit, left-hand side, and then we're going to decrease our premium receivable, which happens to be another asset. So we decrease that premium receivable asset with a credit. So we had a debit of an asset and a credit in an asset, still in balance, the left side and the right side in the same amount. Okay, so this is the key to come back if you're not sure of what does a debit or creditor do, left-hand side, right-hand side of an entry. The only other comments here is how to track the transactions. So everything in here is what I just described. You could read through it. Except this point, when we do these balanced transactions in our worksheets, we want some way to track them so we could see that we have one entry in one account, another entry in another account. Well, how do I tie them together so I could see that, yeah, there's my dual entry. So we just use a little cross-reference tool with the number to indicate which transaction so that we know we're talking about. The left-hand side of transaction one is here. The right-hand side of transaction one is there. If it's in balance, dual entry, my transaction one is complete. So we just use a little footnote, little cross-reference. Okay. All right, so let's jump into the class presentation. I'm going to show you some examples of how to do it in Excel, and then we'll open up how to solve for the practice questions. Practice questions just go through different scenarios, and it's a good way just to jump right into how to run through some scenarios of creating some T account transactions. Okay, so back to our PowerPoint for the class. All right, so this slide here talks about how we form the T. The only thing that it's also showing, and I'll go through this in Excel, is that once we have all of the activity left and right side of the T, we do total up all the transactions that happened over the period of time that we're showing to get a total asset or total debit or total credit activity for each of the accounts. So here's an example using just these three accounts for now. and the idea of cross-referencing the transaction, so you know you have a complete dual entry. All right, so this example, transaction number 1, we have a right-hand side written premium and a left-hand side broker receivable. I've indicated this account A for being an asset. Premium, written premium, SE being shareholders' equity. We'd also show that this is our revenue account as well. Okay, so if you go back to the cheat sheet, an asset account, if we wanted to increase it, we use the left-hand side as a debit. So we're increasing this asset, we're creating a receivable, and we're offsetting it by an increase in our premium. Okay, so this transaction number 1 is what we record when we have a premium sale, where we're going to receive the cash from a broker. Right? We haven't received the cash yet. This is just setting up a receivable and creating the premium. Transaction number 1, again, just accounting activity, organizing it into 2 buckets. Here's bucket 1, bucket 2, left side, right side. All right, so I'm taking my time here going through this in detail because we're going to jump into lots of other examples, but that simple principle of organizing it into the account as best as we can, but making sure left side and right side are equal, and we're using the cross-reference so we don't lose track. Transaction number 2, here we have a commission expense. This is an expense to the insurance company because we're going to pay the broker their commission. Okay, so we're going to record an expense. To increase the expense, you can go back to that cheat sheet. Increase in expense is with the debit on the left-hand side. And what we're going to do is we're going to reduce what the broker owes us. They owe us $1,000 in premium, but we owe them $200 for their commission. So they owe us, the insurance company, less money. So the insurance company records the expense, transaction 2, and here's our reduction of what they owe us, the right-hand side for transaction number 2. Okay. So here's a little trick. What I'm not showing, here's a comment here, is I'm not showing the offset to what transaction 3 is. So this is only half of transaction 3, where we're reducing what the broker owes us by 800. And the reason we would do this is that we would have received cash for the 800. All right, so there's another T account for cash. We increased our cash, 800, reduced what the broker owes us by 800, and we have the 2 entries to show that transaction. The total result of these 3 accounts of what we get is an increase in revenue, an increase of expenses. There's no change in the broker receivable because we had 1,000 up and then 1,000 down, so 1,000 debit, 1,000 credit. And then there's 800 in cash. That's not shown. So we have cash asset went up, our revenue went up, and our expenses went down. So our accounting equation was always in balance because we always did a left-hand side, right-hand side, debit, credit for every step-by-step transaction. Okay, I'm going to switch over to Excel, work through the example, show a couple different types of transactions, and then we'll let you get into where these examples are on Blackboard. Oh, let me get my Excel ready here. Okay. So one of the files that we have to download, the first worksheet, assessment 2, it looks like this, and I have some T accounts ready. I have a couple of sample transactions ready to go. These ones here are similar to what we just did in the PowerPoint, but I include the cash transaction here, number 3. Okay. So if we use Excel, you know, it makes it a little awkward, but try your best to put in some cross-referencing. And if you always want to make sure you're in balance, I actually put in a little formula here. So I'm linked my one half of the transaction to the dual entry on the other one. Okay. So that way I know if I have 1,000 on this side, I have 1,000 on the left-hand side, right-hand side, left-hand side. Okay. I'm going to go through a couple other examples here. So let's go through. We have corporate insurance is paid for the year, and 1 month of the expense is 600. So we paid 7,200, and 1 month of expense is 900. So this is the idea of realization and matching. So even though we're paying for a whole year's worth of expense, we're actually paying it into an asset called prepaid insurance, and then we're going to record 1 month of expense at a time. It's kind of a complicated transaction, but this is just an illustration of how we want the T accounts to stay in balance. If you're ever confused about which account to use, you know, pick one that has the best description. If you indicate if it's an asset or liability or revenue expense, and you're increasing or decreasing it the proper way, you're getting debits and credits. If the account's not exactly right, as we get through more examples in practice, then that'll come. The key now is that we're getting our debits and credits and cross-referencing complete. So in this case, the company paid something, so we're going to have a decrease in cash because the question saying that we paid 7,200. Okay, so to decrease cash, got to credit my asset by the 72, and we're going to create an increase in this new asset called prepaid insurance. So we decrease an asset, increase a different one. But now we're going to go another transaction and record an expense. Increase an expense, debit, left-hand side. Okay. Question tells us it's $600. Increase in the expense 600. And we're going to reduce this asset that we set up as a prepaid. Okay. So our total activity that went through the prepaid account, we increased it 7,200, decreased it 600. Net of the two transactions is an increase of this minus this. Okay, the debit, that's the credit, is the impact of this asset. So here's the cross-reference for item number 8. Here's a cross-reference for transaction number 9. Another one may be that we have a bonus accrual. Accrual just means we want to expense something, but it's not yet paid. Okay. So if our question is saying, an example, we have $1,000 of a expense, increase the expense for the cheat sheet is a left-hand side debit. We're going to set up something that the company owes, something that they will pay. So that means we're going to increase the liability. Okay, so there's our left-hand side debit, right-hand side credit. increased an expense, increased the liability. Okay, so finding the right buckets and making sure we're keeping them in balance. Another question may be, we're going to pay a bonus from the accrued liabilities. So start with what we know. We paid something, so we're going to decrease cash. Cash is an asset. We're decreasing it with the right-hand side. And we're saying that we're not expensing it. We're going to decrease it from this liability we have set up. So to decrease a liability is the left-hand side of this accrued liability account. We don't actually expense anything in this example, okay? Because it's telling us we're paying it from something that was already accrued. If we say there was actual payroll for the month was 400, so we're paying this salary out to staff. So again, we're gonna have a scenario where cash is going down, decrease cash asset, but we're gonna record the salary as an expense. So there's our expense item, left-hand side, okay? So a little different. If there was already a liability set up, we've already expensed it in this bonus scenario. Cash was decreased and the liability was decreased. In the second scenario here for payroll, cash was decreased and we recorded an expense. Okay. And this is just how in Excel, using the T accounts, we're recording the left and the right for these transactions. All right, we're already coming up to 1 o'clock, so I wanted to end it there. So I will guide you through the where these practice questions are in Blackboard. I'll put you into groups, 10 minutes, just so you could get started. Come back. Geez, it's already 1. We'll come back for 5 minutes if there's any quick questions. I'm also going to post office hours, I think for next week or the week after, and then we could go through more T accounts, but we're also going to review these transactions again next week. So if you're struggling through how to even get started in practice, come back to this example. This is also on Blackboard. Work through what you do know, use the cheat sheet. And again, I don't want anyone to get behind in this first building block of understanding T accounts, which is increases and decreases in these certain types of accounts, okay? So let's jump over to Blackboard. I'll show you where we are. So we got week 2, T account practice questions. So I have 4 files in here. So there's assessment 2 and assessment 2 answers. All right, so these are PDF files to get through one set of practice questions. And then assessment 3 is another set of T account practice questions. Both of them are in this Excel file as well. But you need the questions in the PDF, and then the responses are in the Excel file. The Excel file has a blank worksheet for you to put in your responses. Make your best attempt. If you need a hint, just use the answer key as a guide. Don't use it as a crutch, okay? So the answers are here, but work through it on your own. There's answer 2. Here's what we just went through in class. We'll go through the claim example next week. And then assessment 3, blank worksheet is here. And the answer 3 responses are here as well. But again, try to get through it. We'll revisit this process of creating T accounts for certain types of insurance activity next week as well. So you could download these files. I think it's worthwhile if you guys have a chat as a group to help you get you started. Maybe this helps form some homework groups as well. So let me stop talking. Get you into those groups. You could download those off Blackboard. Make sure you're comfortable using Excel to populate these responses. All right, I'll give you 10 minutes. Come back for any quick questions, and then that'll be the end of class. All right, you should get that message for the breakout rooms. All right, I think everybody is back. That was probably a bit mind-blowing for everybody. If it wasn't, then congratulations, you're probably an accountant already. We will. I know I kind of ran out of time today. We'll go through the step by step again next week. The only thing I'm adding on next week is talking about details of claim transactions. So you'll see there's some questions of claims paid and claims being reported. You can make an attempt at it, over the course of the week. That's one where we're going to spend some time on step by step next week. And this idea of how we get from sales, our written premium, to our revenue, our earned premium. So it's just those two concepts for next week, and then going through the details of these different T account transactions. So these two questions, they don't have to be submitted. They're there for your practice questions. We'll use the question number 2 as a practice that we'll go through next week, step by step. But there is value in you making an attempt to go through it beforehand. Then you could see exactly where the gap is, and then you could have some more detailed questions for me next week. Okay, the only thing else I'll leave you with to end the class today is look for an announcement of the office hours, and I'll put you'll see them in the calendar for your program as well. Okay, but that's it for today. Any questions, comments before we sign off? I'll stay on for another 5 minutes. If you don't, feel free to drop off. Yep, go ahead.
There's no assessment which is due otherwise, right? Like
correct. If you
Ms.
didn't,
Blackwood has sent me an email saying that assessment 1 is due today, so I just want to confirm it.
The only thing from week 1 was that overview background one, not the second one. So if the second one is giving you a reminder, then ignore it or press OK. I guess it did have a due date. I'll watch when I set those up next time. It does not have to be submitted.
So the week 1 has to be submitted. The assessment 1 of week 1 has to be submitted.
Yes, the one that was called. Let me go back to it. Week 1 introduction, that one.
Okay.
The week 1 learning assessment does not. Yeah.
Okay. Thank you.
Okay, yeah, you're welcome. All right, thanks everybody. Have a look at the discussion board and those links. Hopefully you've all subscribed to Canadian Underwriter and the business insurance, and you're starting to look for what's going on in the industry as well. That'll help you not just in this course, but in all the courses, and help with your placements as well. Okay, I'm just going to take myself off video. I'm going to stop the recording, but I will stick around for another 5 minutes if there's any questions, comments.